Welcome to Deloitte's Debriefs tax webcast series in Asia Pacific. Our webcast today is from our Geography Update series and is titled Digital Transformation and Sustainability, Tax and Japan's Pursuit of Resilience. My name is David Bickle and I am a tax partner based in our Tokyo office, and I have the pleasure of hosting today's webcast. I have three speakers with me today: Eric Almadronov, Brian Douglas, and Brian Mayer. Eric is a strategy partner with Deloitte Consulting here in Japan and is one of the leaders in our digital services practice. Brian Douglas is a tax director and Brian Mayer is a senior manager, both of them belonging to our business tax services group. And I'm delighted to say that all three are Japan-based, and when not taking advantage of the flexibility of home working, they can be found in our Tokyo office. And if you'd like to check on our bios, you may access these from the left-hand side of your screen. Now, before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features on your webcast console. Firstly, all users are on listen-only mode, so if you have any content-related questions, you can submit these at any time in the Q&A box at the bottom right-hand side of the screen, and we will do our best to respond to these during the presentation. Secondly, all PC users can maximize or minimize each box at their convenience during the webcast, and you may also explore the icons at the bottom of the screen. And for those that want to download today's slides and the related publications, please go to the Downloads and Links box. And alternatively, if you are on the move today and are viewing from a mobile device, you can also see all of today's slides on your screen and respond to the survey questions as well. And thirdly and finally, if you require an attendance record for this event, you can download your CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Okay, so let's now turn to the theme of today's event. And as a reminder, we titled this Digital Transformation, DX and Sustainability, Tax and Japan's Pursuit of Resilience. So why the link between DX, digital transformation, sustainability and resilience in the context of a discussion about tax? Well, that goes back to the shifting impetus behind the drivers of the Japanese government's tax policy. Now, looking back several years, this policy was driven by the agenda of then Prime Minister Shinzo Abe and was dubbed Abenomics, and in particular the so-called third arrow around his growth strategy. And the growth strategy remained an important theme throughout Prime Minister Abe's tenure, but over the last 3 or 4 years, it was the work of the OECD's Base Erosion and Profit Shifting, more commonly known by its acronym of BEPS, that agenda that drove tax law changes here in Japan aimed at strengthening tax compliance and anti-avoidance. That then brings us to the present, where the 2021 tax reform announced at the end of last year reflected the policy priorities of Abe's replacement as Prime Minister, Yoshihide Suga. Policies designed to address some of Japan's and the world's most pressing problems, namely climate change, cyber vulnerability, and the lingering concerns over economic weaknesses, resulted in tax policies in support of digitalization and sustainability, which look to help bolster Japan's resilience to these challenges. Now, as most listeners will be aware, Japan now has a new Prime Minister, Fumio Kishida, following a recent leadership election within the ruling Liberal Democrat Party, and he is expected to go on to win a governing mandate from the people of Japan in a general election that will take place this coming Sunday on the 31st of October. And it will be interesting to see how his priorities and his agenda shape the 2022 tax reform measures that will likely be announced not too long afterwards at the beginning of December. It's not just tax, though, which is driving the accelerating pace towards digitalization. There is a need in Japan to implement more modern IT systems architecture, including cloud-based, that is more robust and resilient to the burgeoning threat of cybercrime. And there's also pressure as well to innovate and leverage technology in support of new business and operating models that offer the hope of new sources of revenue and increased productivity. Beyond that, however, as in the rest of the world, it is the COVID pandemic which has driven companies to digitize more and more of their processes and to invest in technologies that enable their people to collaborate remotely in the virtual environment. And in terms of business operations, the operations of the tax function are, just like any other corporate functions, undergoing a wave of digital transformation. As ever, this is driven by pressure to deliver a greater contribution to the business, but with fewer resources. So by increasing efficiency and enabling the outsourcing of, for example, compliance functions. Importantly, however, we're also seeing an increasing shift from the Japanese tax authorities towards digital tax administration. And whilst not as rapid and as yet far-reaching as that seen in some other countries, the ongoing changes in how the Japanese government wishes to interact with taxpayers through the medium of technology will continue to drive the digitalization of tax operations in the years to come. So in summary then, as a result of these drivers, we've seen a trend towards increased digitalization, and due to the ongoing prevalence of these drivers and the necessity of achieving greater resilience, the trend towards digitalization looks set to continue. Okay, so in the context, it's in the context of that background that we want to focus today's agenda on the following matters. Now, firstly, I want to leverage Eric's experience in the commercial world of digital to share some insights about Japan's experience with cloud-based technology. And from there, I'd like us to take a look at the latest developments around the uptake of Japan's tax incentives that the country has introduced for investment in cloud technology. After that, we'll try to provide some a bit more practical context for the discussion of digital with some case studies as well, once again, leveraging Eric's experience. And we'll then look at another aspect of resilience that I spoke of earlier, and that is the resilience to climate change. And we'll do that by catching up on the latest in connection with Japan's tax incentives for investment in carbon neutrality, before wrapping up with a look at one of the most pressing compliance issues that Japanese companies need to address at the moment, and that's in connection with the electronic storage of documentation. And with the new compliance deadlines for that documentation requirement coming into force in January next year, this will hopefully be a timely reminder for those that are already addressing this, and perhaps a call to action for those that are just starting to get to grips with the implications. Okay, well, that's more than enough talking from me, but before handing over to Eric, I'd like to kick off with a polling question. And the question is, based on your experience with businesses in Japan, what best describes Japan's state of readiness for cloud and digital transformation? And your options are: Japan leads Asia Pacific in its readiness for cloud and digital transformation. Japan is a fast follower and stays current on technology trends compared to other markets. Thirdly, Japan is below average in its readiness for cloud and digital transformation compared to other AP markets. Fourthly, Japan's readiness for cloud and digital transformation lags behind compared to other AP markets, and it needs to catch up quickly. And finally, don't know or not applicable. And so while we're waiting for the results to come in, I'd like to hand over to Eric. So Eric, welcome. And I'd be grateful if you could share with us, please, some of the things that you're seeing from the consultant's perspective in relation to digital and the cloud here in Japan.
Great. Thanks, David. And thanks. Good afternoon, all, and thanks for joining us for today's webinar. As we wait for the polling questions to come in, please again respond directly to the poll. I will say in advance that we asked a similar set of questions to executives in Asia Pacific, as well as executives in Japan. So ultimately, I'd like to be able to compare results that we get, via this webinar versus what we've seen in some prior research. So just by brief way of introduction, as David said, I'm a consulting partner for Deloitte Japan. I do a lot of work in cloud transformation and technology strategy. And given some of the changes in tax laws, right, created in Japan, we believe that there are going to be very significant opportunities for companies doing business in Japan to qualify for some of those initiatives and reap some of the benefits of those tax incentives. So I don't know if we're quite ready. Are we able to see the poll results just yet? Okay, great. It looks as if most are not sure if Japan is ready or not. And my brief reading of this says that we are either in Japan slightly below average in its readiness for cloud, or its Japan readiness for cloud really lags behind the rest of AP and other markets. Right? So I will kind of share with you in advance that is relatively consistent, right, with some past results, which I'll show you in a moment. But I think it's good to highlight this as a means for talking about resilience, cloud, and Japan, and what we have to do in order to be ready to do resilience and do cloud more effectively in Japan. So let me start with just a brief overview, and I'll credit our friends at Gartner, right, for the next couple of data points. That growth in cloud spending outpaces spend for all other investments in IT and digital transformation, with 5-year CAGR of roughly almost 21%. Okay? Cloud now globally represents about 10% of total IT spending, and again, the growth in cloud and cloud spend basically leads all other types of spend for digital transformation and IT. Right? In that context, though, if we look at how Japan is actually comparing to the rest of the world on the next slide, Japan, what we find is that Japan is falling behind other regions, both from a cloud adoption perspective, right, as well as from a total spend perspective. You'll notice Japan in that bottom right-hand corner, right? What that is basically saying is that Japan, among all those markets, is spending less than all of them as a percentage of its IT budget on cloud, compared to, say, leaders like North America, which are spending upwards of 14-15%, right, of their budgets on cloud. China, right, is closer to 11%. If we look at where Japan is, a little bit better than 4%. So it shows from a pure cloud and cloud adoption perspective, right, that Japan is really lagging behind other major markets. I guess the one kind of encouraging sign is that the rate of growth in cloud spend for Japan is picking up, and it's starting to be competitive. However, when you compare Japan to both Greater China as well as emerging Asia Pacific markets, right, it's actually still lagging those markets from a growth perspective, right? So all this means that that Japan really lags behind from both a cloud adoption, cloud spending perspective. Let's take a look on the next slide of how it is that this is manifesting itself in terms of what executives are saying about cloud readiness. So this is some research that was sponsored by Deloitte Access Economics, right? That we were involved with, where we were asking executives around AP about overall readiness for cloud. The high-level results, right, are that about 54% of all executives in Asia Pacific believe that their markets are either focused or primed, i.e., they are ready, right, for cloud, right, or a simple majority is believe that they are ready for cloud. If we look at the comparable numbers for Japan, and again, the comparison here is Japan versus other AP markets, only 22% of executives in Japan believe that Japan is cloud ready, and almost half of them, like close to 43%, basically think that Japan is unprepared. So going back to our original survey question, right, where a slight majority of you all said, at least for those who answered not applicable, how does Japan rank compared to other AP markets? Based on our research, most executives doing business in Japan actually believe Japan is really lagging, right, from a readiness perspective for cloud and also for digital transformation. Okay, so let's take a look at how that actually compares on the next slide to other markets in Asia Pacific. We actually ranked all of these markets by country, and I will not go through the extensive methodology used, right, to be able to come up with a cloud readiness score. However, what we find is that China and India are leading the pack, right, from a cloud readiness perspective, and that Japan is actually bringing up the rear, right, in all of AP from a readiness perspective. So for all of us that live and work and do business in Japan, right, this is a kind of major structural hurdle, right, and one that those that want to be able to do effective digital transformation in Japan basically have to take into account and be ready for, right? Because as we've seen, adoption is quite low, and then readiness, right, in Japan compared to other markets in Asia Pacific is quite low. Let's take a quick look at what we believe are some of the results, right, of that, right, on the next slide, if we could. So we have a thesis that the low investments and readiness for cloud in Japan is a contributor to overall low labor productivity for Japanese workers compared to other major economies. What we are looking at is labor productivity, by or GDP by number of hours worked, right? And what we find is that Japan's GDP per hours worked is actually relatively low, and more akin to, what our colleagues in Greece or Mexico might be doing versus, say, Ireland and Norway, Germany, U.S. and other places. So I think it's well known and understood that there are worker productivity issues, right, in Japan. And our major thesis is that digital transformation and cloud readiness are one of the reasons why Japan lags, right, most other markets from a productivity perspective. But it's not only about worker productivity, right? Let's take a look at the next slide. In addition to low worker productivity, we also find, and this is from a different study, that the slow pace of digital transformation in Japan is contributing to lower overall employee engagement, right, compared to other OECD countries. If we look at where Japan ranks in terms of percentage of employees that actually report they are engaged with their work, only 7%, right, of those are actually saying that they're engaged. 24%, almost 1 in 4, are saying they're actively disengaged, right, from their work and from their jobs, right? So again, our thesis is that the low adoption for cloud, low adoption broadly for digital transformation is a major contributor not only to lower worker productivity, but also lower employee engagement that we observe in Japan. So if that kind of sets up the problem, right, and I hope that sets up the problem, I'd like to ask my colleague Brian, if this is the problem, what sorts of things is the Japanese government doing to be able to address that issue via some of the tax incentives that are being offered today? So, Brian, off to you.
All right, thank you, Eric. And as you mentioned, one of the mechanisms that the government is using to address this issue is tax policy, and it's doing this with what we refer to as the digital transformation tax incentive, which allows companies to take a tax credit or special depreciation based on the amount of investment that it makes in its own digital transformation. Now, this incentive was enacted earlier this year and applies right now through the end of March 2023, and we've been working with a number of companies who are looking to apply this incentive. And I'd like to share a little bit of what we've been learning about the process of applying for this particular incentive. But before doing so, I think it's worth spending a few minutes on some of the components and requirements that make up this tax incentive.
Brian, just before that, can you briefly explain what special depreciation is, please, as I think some of the participants today might not be familiar with that term?
Sure. So I think special depreciation is sometimes referred to in other countries as a bonus depreciation, and essentially it accelerates a portion of depreciation deduction on an asset that a company would take in a subsequent year and accelerates that to the current year. So in other words, the company gets a larger deduction against its taxable income now and a smaller deduction later on.
So I understand that's basically shifting the timing of the deduction rather than providing additional cash tax savings over the life of the particular asset. But in contrast, the tax credit that you mentioned provides a permanent incremental cash tax saving opportunity. Is that right?
Yes, that's correct. So and companies are able to choose whether to take a tax credit or the special depreciation, and you'd expect most companies to opt for the tax credit given the cash savings. But there are situations where a credit may be significantly limited, and they would opt to take special depreciation. So that's really the potential benefit to the company. Now let me move on to some of the requirements regarding this incentive. So the key requirement, as you've seen in the middle of this slide, revolves around what we call a business adaptation plan. And this is a plan that the company must prepare and get approved by the government. And once that plan is approved, it's simply a matter of executing on that plan, proceeding with the digital transformation, purchasing the eligible assets, and calculating the tax credit or the special depreciation to include on the company's tax return. The difficulty, or I think the area where the company will need to put the most effort into is really just the drafting of a well-thought-out, comprehensive business adaptation plan that clearly shows how the company will invest in its digital transformation and how it will satisfy all of the digital and business transformation requirements that are listed on the top of this slide. So, for example, a company must show how the company will utilize cloud technology and how that investment will contribute to the productivity improvement or increased sales of the company. Now, one requirement within the digital requirements box that I'd like to highlight is the acquisition of a what's called a DX certification, as this requirement kind of has its own process of approval and its own requirements within it. So just briefly, the DX certification is a certification that's granted by the Japanese Information Technology Promotion Agency to companies that demonstrate or satisfy basic standards under a digital governance code. So among others, this would include formulating and publicizing the company's strategy to incorporate digital technology into the operating model of the company as a whole, and explain the company's approach to cybersecurity measures. This certificate must be granted before the business adaptation plan will be approved by the government. So those are some of the contents or the requirements that are needed to be included in the plan. Now I'd like to move on to talk a little bit about the process of how companies can get that plan approved.
And Brian, just before we do move on, there's one question I often receive when discussing this incentive with clients, and I assume that some of our participants listening today may have a similar question. Regarding the investment in assets, what exactly is a deferred asset, which you show on the slide here? I think most people are familiar with a deferred tax asset, but that's not what we're talking about here, is it?
No, that's right. So under Japanese tax law, a deferred asset is generally costs or payments for something, let's say a service, where the benefit of that service will last beyond the year. So these types of costs would typically be capitalized and amortized over a certain period. So an example in this context might be a cost the company will incur to move data from legacy systems onto the cloud. And this cost may be paid to an IT or consulting firm that assists the company to do that migration to the cloud. Now, regarding the process, I think the first point I'd like to make is that it will take some time to obtain approval for the business adaptation plan, including the time that it's going to take to obtain a DX certification. Now, we would expect or estimate that the process from the time it's decided to consider this incentive to the time that a company would obtain approval may be 5 to 6 months for most companies. And this is important to understand because only the investments that are made after the approval of the business plan, only those assets are eligible for the incentive. So there's a little bit of a lead time that's required before a company can really start to acquire the assets mentioned on the previous page, such as software or paying companies to migrate data to the cloud, etc. But at the same time, all of these investments also need to be made prior to the end of March 2023 when this incentive expires.
And that's a narrow period of time for making what could be some very significant investments in terms of the amount of cash involved. One more question. I understand there are two processes. There's DX certification, and then there's the business adaptation plan. So since this company would be undertaking these processes in order to obtain a tax benefit, is the tax department within a company or a taxpayer, is the tax department generally leading both of these application processes?
So I would say generally no. So first, this tax incentive is not the only reason for companies to obtain a DX certification. In fact, there are several companies that have already obtained DX certification but are not pursuing this incentive. And one reason, other than the tax incentive, to obtain the DX certification is that some companies feel having that certification gives them a certain status as a company that's really focused on utilizing digital technology, which may help them attract and retain badly needed talent who have digital and IT experience. And second, the DX certification deals with digital governance, which is typically outside the responsibility of tax. So often a separate team would lead that effort. However, it is important for that team and the tax team that may be pursuing approval of the business adaptation plan to talk to each other because there is some overlap. For example, some of the content that is used in the DX certificate application might be able to be used in the business adaptation plan. So the other point I like to make on this slide is that pre-consultation with the government is actually required as part of this process. So typically what would happen is that a company would submit a draft business adaptation plan online. The government would review it and set up a consultation meeting. These meetings are quite valuable as they help identify issues or reasons why the government may reject the business plan, and it really allows the company to make changes before final submission. For example, we are working with a company that plans to incur costs to upgrade its ERP system, which constitute a significant part of their transformation costs. And we were informed during this consultation meeting that the connection that the company made between the ERP investment and how it would improve productivity was quite weak, and that the government would not allow that cost to be eligible for the incentive. So the company was able to rethink how the ERP upgrade fits into its overall transformation, and was able to show qualitatively and quantitatively in an updated business plan that investment would contribute to the company's productivity. So I think the point there is that the pre-consultation meetings are helpful, and also the types of investments that are eligible for this tax incentive may be broader than you might expect. I think the key is being able to connect those investments directly to the requirements. So I think that's what I'd like to share about some of our experience with working with companies looking at applying this digital transformation tax incentive. And Eric, that was maybe a little bit of a long way of addressing your question that, the government is using tax policy to try to address Japan's lag behind other Asia-Pacific countries. And I'll hand it back over to you, Eric.
Great. Thanks, Brian. So let's take a look at some case studies of companies that at a minimum are in the process or have already completed applying for the DX certification, which in turn sets up the ability, right, to qualify for the tax incentives. I guess I should say first off that it's very rare that we see any companies, right, saying, "Oh, there's a tax incentive, I should do cloud. Oh, there's a tax incentive, we should do digital transformation," right? It is quite often the case, right, as you can imagine, that there are already significant DX transformations that are either planned or already occurring, and that this tax incentive, right, that's being offered by Japan basically serves as a motivator to do it soon, right, or to do it now. I believe David a little while ago mentioned a relatively narrow window, right, in which to qualify for some of these incentives. So while tax is not the primary motivator, right, for embarking on a digital transformation program, it's certainly a motivator for accelerating it in your schedule, right, and trying to do it sooner than later. So with that, there are a few different, cases. An electrical equipment manufacturer wanted to modernize its back office applications, and it was quite interested in how it could use some of the tax incentives to be able to support productivity gains and modernizing those back office operations. There's a construction company, and Brian referred to a kind of similar use case in the past, that wanted to be able to improve its image and branding. So if I have my DX certification from the Japanese government, that's a certain type of good housekeeping seal of approval, if you will, that this is a company that's well on its way to using digital as a part of the business, right, and using it as an enabler for both innovation, new business models, productivity, et cetera. That was a construction company. Another insurance company, was actually quite interested in being able to improve investor relations, right, and to be able to use the DX certification as a means of being able to demonstrate, right, to its investors that it was serious, right, about digital transformation and the efforts and the costs, right, that would be involved. I guess what all of these companies, right, have in common is, one, these are all companies that Deloitte is working with, right, to obtain their DX certification. That some of them have already gone through that process, or others are in the process of completing it, and that they're all now kind of well on their way towards qualifying, right, for those incentives for the DX certification, and hence the incentives. Let's take another just brief look at another set of cases. And I believe right now on the next slide, Deloitte in Japan is supporting about 15 or so clients, right, in terms of applying for and receiving its DX certification. One interesting use case for a chemical engineering company, of course, there's been a lot of discussion about how we better use data, analytics, AI, machine learning, right, to be able to drive better business decisions, right? This chemical engineering company wanted to do something quite similar and use analytics to increase their productivity and increase their productivity. So that for them was the primary motivator. A technology company also that we're working with wanted to be able to use some of the incentive created by the tax incentive to improve their innovation processes, right? Which is a prerequisite for or could be a prerequisite for some of the incentives. And then I think, as Brian mentioned earlier, others still, are interested in getting the DX certification in the case of this metal and materials company for being able to strengthen digital governance. Right? So again, all examples of different companies, right? Chemical engineering, tech, and then metal and materials that have somewhat different motivations, right, for obtaining their DX certification, but are united by getting this DX certification and being able to qualify in turn, right, for those taxes to support those business initiatives. So let's move to the next, and I'll leave you with a short other case study. This is a client of mine that is a well-known global restaurant company with a very significant presence in Japan. In this particular case, I believe it was in fall of 2018, they recognized that they needed to improve their resilience, right? And why? Because in the fall of that year, they had a major data center outage, right, that impacted 6 of their key business applications, and it had an indirect, impact on better than 50 plus systems, right, that supported both back office as well as in-store operations. Things like their point of sale systems, their promotion systems, new product innovation and rollout, lost IP and human resource data, even some of the systems related to supplies and procurement were also impacting delivery and obviously being able to serve their customers. Right? This is a major outage. In total, it took close to 2 months worth of time, right, to be able to recover from this, and it cost this company upwards of $10 million, right, to be able to fix some of the incidents that led up to this outage. So this is a very clear example, right, of a company in Japan that recognized through a failure, right, that they had severe issues related to resilience. And what it did is it embarked on a digital transformation program and cloud migration program to help modernize, update, and ultimately make its systems, more resilient. So on the next slide, let's take a look at some of the results, right, of that transformation. They are already seeing some very positive results as a result. They've been able to reduce their operating costs from a technology perspective by close to 50%. They've been, experiencing steady state savings of about $2.5 million per year as a result of the app migration. And then, of course, they now also are, since they're still in the process of the migration, now interested in using some of the incentives being offered by the government, right, to help offset some of these costs from a tax perspective. So I hope that the case studies that we shared illustrate some of the issues around resilience and then the different motivations, right, that companies in Japan are using to apply for and acquire their DX certification. So let me just recap on the final slide. Our major discussion. We said in the beginning that cloud is growing quite aggressively, right? It's growing at better than a 20% rate and will for the foreseeable future, at least through 2025. We furthermore saw that Japan is behind, right, from a DX and a cloud perspective, we said that the digital or cloud readiness in Japan was quite low, not only compared globally, but in particular to some of its colleagues in Asia Pacific, like China and India. However, there are some ways forward, right? As Brian pointed out, there are new tax incentives that are available to help support the digital transformation efforts, and some of our clients are using those incentives to invest in digital transformation and better productivity tools, including cloud. And then finally, we finished up with some examples of companies that were taking advantage of these new incentives to apply for and get their DX certifications and ultimately help to improve their company's sales and their productivity. So with that, I'm going to turn it back to David, and again, wanted to thank all those who joined our webinar today for listening in. So David, please.
And thank you, Eric, as well, for sharing those insights. And it certainly sounds like Japan has a bit of catching up to do with the rest of Asia Pacific and probably much of the world, for that matter, from a digital transformation perspective. But on a positive angle, it's currently at least starting to take some steps to do this. Okay, so if we could switch gears for a moment, though, and look now at another type of transformation that Japan is focused on, and that is the so-called green transformation. Here there are parallels with the approach taken for digital transformation, with Japan, again, using its tax policy to encourage companies to transform from a green or a sustainability perspective. So Brian Douglas, if I can bring you back again, if I may, could you please walk us through how the government is encouraging companies, at least in terms of tax incentives, to go green?
Sure. So Japan created what we call a carbon neutral tax incentive as part of the 2021 tax reform, along with the digital transformation tax incentive we just spoke about. And on the slide, you may have noticed that this slide is very similar to the slide regarding the digital transformation incentive, and that's because the approach the government takes is very similar. So again, the benefit to companies is a reduction to the corporate tax liability via either a tax credit or special depreciation based on the amount of investment the company makes, and you can see that in the bottom right of the screen here. And similarly, the company will need to obtain approval on a business adaptation plan. Now, there are two types of investments that will qualify for this incentive. Investments in machinery that produce what we'll call green products, and investments in facilities that increase the company's carbon efficiency. Now, regarding the green products, these are generally limited to the following, and that's compound semiconductors, lithium-ion batteries that are used in electric vehicles or even stationary batteries, certain types of fuel cells, and products related to offshore wind power generation, such as the generators, gearboxes, towers, etc. So if your company produces these types of products in Japan, then this is an incentive you may want to take a deeper look at. However, I would guess that most companies probably don't produce these specific products. Now, regarding increasing the carbon efficiency or investments in facilities that increase carbon efficiency, this type of investment should be applicable to a broader range of companies, but at least in my mind, may be more difficult to determine and requires a lot of input from the team in charge of sustainability at your firm, who has access to data regarding companies' CO2 emissions.
So, Brian, how is the so-called carbon efficiency measured then?
Well, it's measured by the value added by the company, and this is measured by factors such as the income the company generates, salaries that are paid, depreciation taken on capital assets, over the company's CO2 emissions. And those emissions are determined by a specific formula based on the type of energy that the company consumes. So in order to increase the carbon efficiency of a company, the company either needs to increase its value add or decrease its CO2 emissions, or both.
And can we assume that, similar to the digital transformation incentive, the DX incentive, only investment that takes place after the business adaptation plan is approved is going to be eligible for this incentive?
Yes, that's correct. But maybe with one difference being that companies will have until March 2024 to make their investment under the carbon neutral tax incentive. So there's an additional year in which companies can make that investment, at least relative to the DX incentives.
Okay, well, thanks very much for that, Brian. And that brings us to the second polling question for the day. So to wrap up our discussion on incentives, the question is, do you believe these tax incentives, and that's for investment in cloud and investment in carbon neutrality, do you believe that these tax incentives will cause you to make additional investments in the cloud and carbon reduction? So the options here are, yes, maybe additional investment in cloud technology, yes, maybe in carbon reduction, yes, maybe in both cloud and carbon reduction, or maybe number 4 is no, we plan to invest regardless, though, of the incentives. And number 5, no, we do not expect these incentives to impact our decision and have no plan to invest. So while we're waiting for the results to come in, Brian, just before I let you go, thinking ahead to the 2022 Japan tax reform, and given the focus on digital transformation and green transformation in Japan, do you think we can expect other incentives to be offered by the Japanese government?
Well, I think we might see something, but it's really hard to say, as the official proposals for the 2022 tax reform won't be available until mid-December. But there are some business organizations that have made some suggestions to the government to include in the 2022 tax reforms, and these suggestions include like eliminating property taxes on carbon neutral plant and equipment, and expanding an existing incentive that encourages large businesses to invest in startup companies. And while that is not specific or necessarily specific to digital or green transformation, you can imagine that there could be many startups that are addressing these digital and sustainability issues.
It seems the results have come in. So any thoughts on what we can see on screen now?
Yeah, so it looks like perhaps the majority of the individuals that responded said yes, maybe, in both cloud and carbon reduction. And it's not too surprising, as I think tax incentives do reduce the financial burden for companies to make these types of investments, though I suspect, and as Eric alluded to earlier, there are probably a lot of other drivers also pushing companies to make these types of investments.
Okay, well, thanks very much for that, Brian. And moving on now to Brian Mayer, I'd like us to switch away from tax incentives and focus on a very important practical matter, still in connection with technology, but this time relating to the storage, the electronic storage of documents. So, Brian Mayer, over to you, please.
Thanks, David. So, as you mentioned earlier, one of the areas the Japan Tax Authority is focusing on in terms of DX is this concept of electronic record retention. Now, as some of you may know, under current Japanese rules, your books and records and other tax-related documents are required to be kept in hard copy for a period of 7 to 10 years. And the storing of these documents in a digital format is generally only allowed if an application for approval has been submitted and the documents are stored in a manner which meets the specific requirements under the Electronic Record Retention Law, or the ERRL for short. So with that being said, in the context of the current push for DX, the administrative requirements for saving documents electronically under the ERRL are set to be eased, and the application for approval will no longer be required. This will be effective from 1st January of 2022. And on top of this, for electronic transaction records where no original paper copy exists, the documents are actually required to be stored electronically in line with the requirements of the ERRL from the beginning of next year, and the retention of such documents in paper form will actually no longer be allowed.
Brian, when you refer to electronic transaction records, what type of documents are you actually referring to? Could you provide a few examples, please?
Sure. So electronic transaction records specifically refers to transactional type documents which have been exchanged in a digital format. So say a contract with a customer or an invoice from a vendor which has been sent or received in PDF or by email, or a transaction conducted through an EDI system. And this would not include, for example, your accounting books, financial statements, or transactional documents which have been exchanged in paper form. So for these other types of documents, it's still acceptable to maintain them in paper copy, although as I mentioned earlier, the requirements for going digital have been somewhat relaxed. And considering that an application for approval will no longer be required, we're seeing companies in Japan viewing this as an opportunity to move fully digital with their documents. And so on the next slide, if we could, perhaps this better helps to visualize how the different types of documents are classified under this ERRL. So for starters, on the far left, we have a company's accounting books. So this would include your general ledgers, journals, things of that nature. And then the three columns on the right refer to other records which may be relevant for tax purposes. This would include internally generated documents such as your balance sheet, your P&L statement. It would include paper documents which have been received from counterparties or vendors. And on the far right here, we see these electronic transaction records, which I referred to earlier. So as you can see, the requirements for storing each type of document actually differ slightly. And these are separated into two categories. So regarding the integrity of the document and the visibility of the document. And given that these electronic transaction records on the right are required to be kept in digital form from 1st January, I'd like to spend the next couple minutes going over what the specific requirements are to do so, and some of the potential difficulties we're seeing from our discussions with clients on this topic. So we've summarized here how these electronic transaction records will need to be maintained in terms of the integrity of the document, which I mentioned is one of the requirements. It's important to note here that only one of these four items listed is actually required to be met in order to be compliant. So given some of the potential hurdles in using timestamps, as we see in items 1 and 2 at the top, we're seeing a number of companies intending to satisfy the integrity conditions by instead focusing on item 4 at the bottom, which is developing your own internal set of policies regarding corrections or deletions to electronic records as a way to meet this requirement. So similarly, requirements regarding visibility will also need to be met. And while there's 3 separate requirements here, which all need to be met, in this case, we tend to see more focus on the search function element at the bottom here. And we'd recommend companies confirm that their ERP or similar systems are able to search by the key data items. These include date, amount, and counterparty to a transaction, and that their system also has the ability to search by a range of dates or amounts in case of a request from the tax authority.
And given the overall increase in digital transactions, it seems that this is going to impact a large number of companies. So do we have any idea on what the consequences would be for non-compliance with these rules?
Yeah, that's a great question, and it's certainly been a topic of interest in our discussions with companies here in Japan. So we can see here, while the tax authority has made it clear they want to make it easier for companies to go digital, they've also at the same time added more severe penalties for cases of fraud or concealment relating to electronic records, and they've raised the penalty tax in this instance by 10% for these types of cases. However, I think perhaps the most significant concern for companies should be that any document which is subject to the electronic record retention rules but doesn't meet the requirements, then this document would not be considered as a valid document for Japanese tax purposes. And I bring this up because this is an important point for being eligible for what's referred to as blue form taxpayer status in Japan. And this status allows a taxpayer access to certain tax credits and incentives, and importantly, the ability to carry forward net operating losses. So if the requirements are not being met, there is this potential risk that the tax authority could revoke a company's blue form status, and they would lose out on these important attributes, which is why we're advising companies to ensure they're compliant with these rules. Back to you, David.
Okay, thanks very much, Brian. And we're getting to close to the top of the hour. So thank you as well. Well, thank you, Brian. Thank you as well to Eric, and thank you also to our other Brian Douglas. This actually brings us to the end of our today's discussion, and we now have just a minute or two to respond to a couple of the questions, hopefully, that have come in that we've received from the audience. But there's one here, I think, which follows on nicely, Brian Mayer, from the topic you were just describing. And someone's written in to say, talking about their company, our books and records for Japan are kept electronically in the accounting software we use globally. Does this mean we have to update our whole global system just to meet the requirements for Japan? Great question. Can you just share a perspective on that, please?
Yeah, so this is a common question we receive in our discussion with companies in Japan. And the short answer is yes, your system maintaining your books for Japan would need to meet the requirements of the ERL in order to store documents for Japan digitally. Now, with that being said, where it's not feasible to update your global system just for Japan, there are certain workarounds which can be put in place. So, for example, a search function, if it doesn't meet the specific requirements of the ERL, the documents for Japan could be listed up in a separate file. So, for example, an Excel file, which has the appropriate search functionality. This may not be feasible for companies with a high volume of transactions, so we're recommending to them to check whether their global systems are in line with the ERL, and where gaps do exist, to consider how best to bridge these gaps. So I hope that answers the question.
Perfect timing, Brian. Thank you. Look, thanks very much. And I can see now, I think we're 1 minute to the top of the hour. So unfortunately, that is all we have time for today. So once again, to Eric, to Brian Douglas, and to Brian Mayer, thank you. And special thanks to all of you who were able to join us online in our audience today. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. And if you feel that others in your organization would benefit from this webcast, please share the webcast via the share this icon, or have them visit the Deloitte Debriefs website. We will respond to all the questions submitted. There are a few other ones during the webcast today within the next couple of weeks. Also, if you think of any other questions or comments later, please do feel free to reach out either to me or to one of our speakers directly, and we'd be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Geography Update series. And this is on the 2nd of November and is titled Investing in Australia, Getting the Setup Right. So at last, from all of us here at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.